Hello everyone, today we're going to be doing another episode of Over or Under, and today we'll be talking about Lululemon. So let's look at some chart data quick. One day down 0.15%, up 5% for the week. For the month down 14%, 3 months down 26%, year to date down 55%, year 37% down, 5 year down 41%, and max they're doing great. So a lot going on there, but you'll see the trend, and you can see it in the chart here, is that they had exponential growth, and then as of lately, their price has just been dropping like crazy. So there was some sentiment behind that of why that's all going on, and I think it's important to read the stories before we get into the actual valuation of it. But before we do that, we'll see it's currently trading at $169. And if we go down, we can see some analyst ratings, 26% at a buy, 64% at a hold, and 8% at a sell rating. But if we look at Morningstar, they have the fair value valuation at $295, economic moat narrow, which we'll get into, uncertainty high, which we'll also get into, and stewardship exemplary, no concernings. We can see their earnings, pretty profitable, pretty stagnant though if we look at earnings, but a lot going on there. So according to Morningstar, this stock is incredibly undervalued, but according to public sentiment, it isn't, and that it seems like it's on the downward spiral. So currently at $169, let's look at some stories behind this. Why Lululemon's battle with Costco can make or break its stock by the Motley Fool. And this comes from the fact that Lululemon is suing Costco because they're claiming they sell duplicates of their products. So basically, Lululemon is seen as luxury goods, very high quality, it's athleisure, and Costco is coming out and basically selling similar, if not the same thing, for a fraction of the cost, as we know Costco does. So Lululemon is claiming they're kind of infringing on the copyright of it, just selling duplicates of their products. So that's going to go on in a lawsuit. And people's concern with this is that Lululemon is very focused on dupes, but not as focused on their own company. So they're concerned about all these competitors, which shows they have issues with competitors, rather than focusing on growing their brand and kind of working on that. So public sentiment is a little wary when it comes around that. Now, if we're looking at Seeking Alpha here, we'll just look at the summaries. I was reading into this article in total, and it supports what it was saying. So we look at the summary. Lululemon Athletica faces slowing sales growth, margin contraction, and weak forward guidance, justifying a continued bearish outlook. So there was a bear that wrote this article, and yeah, they were true. There was some margin contraction, nothing crazy, honestly. Slowing sales growth, yep, which we'll see here. Revealed the lowest revenue growth in 3 years. That happened in Q2, so revenue growth has been decreasing. Domestic sales stagnating and inventory levels rising sharply. So basically, they're not having as high of turnover before with their products. It's not turning over as fast. It's not as accelerating as it used to be. Profitability is deteriorating. Gross and operating margins contracted, and EPS guidance for both Q3 and full year points to further declines. So they're losing some of their margin, which happens if you're going to have something like dupes, and people aren't going to pay as much for the product as they used to, especially as Lululemon was popping off, and it seems like no one could stop talking about it. It's the next hot thing. They're going to start losing some of that traction, some of that steam, and they won't be able to charge the prices that they previously did. Or if they're going to, it's going to take longer for their inventory to turn over, which will directly affect revenue. And closing point, despite a much lower valuation, I reiterate a sell rating on Lulu as negative trends and lack of catalyst suggest more downside risk ahead. So basically they're saying with all that in mind, there's nothing seen on the horizon that's going to kind of bring about a relevant change. So these are some things when we get into this valuation, we look at the metrics. They're important to take into consideration because a DCF valuation isn't everything. It is very important and tells a lot about the company and kind of gets a lot of that biased out and all that noise. But when it comes down to it, it is important that we also understand metrics like this, which aren't necessarily seen in the numbers. So there's stories going on. They're basically on shaky ground, is what the author of this article is saying. So let's get into the actual valuation now and look at some of the charts that may or may not reflect this information. Ooh. So we'll be doing the valuation, our studio. We're going to load in several metrics and take a look at that. We got date, revenue, operating expense, operating income, net income, earnings per share diluted. So taking into consideration new shares being issued, free cash flow, and price to sales ratio. So first, let's load in this first chart. Take a look at a couple of these metrics. So in black, we got revenue. Operating expense is in maroon. We're going to have operating income in green and net income in blue. So you'll see kind of a trend here. All these more or less go along with each other. You'll see revenue going up, net income going up, operating expenses go up with revenue, and operating income as the bottom line also go up. So you'll see these spikes, and that I'm guessing is just Q4 of everything. Q4 is where a bunch of sales happen. We got holiday shopping, end of the year bonuses, and all that. And this is very common to see in the sales world. You're going to have inconsistent revenues. It's not something like, I don't know, Adobe or Apple where you have consistent subscription revenue that you can easily chart. When it comes to sales and you're working in that, it's a lot more difficult. You're going to see numbers all over the board, inconsistent at times, so it's a little more difficult to analyze. So along with that, let's see. We did also have the free cash flow here, which I wanted to take a look at. Free cash flow, I think, is the baseline for any company. Unless they're a startup that's not profitable, you should be looking at free cash flow. If the business isn't free cash flowing, no matter what you got on net income, your revenue, any of that, operating income, it doesn't matter. Free cash flow is that baseline of what they're bringing in, minus all the expenses in mind. So you can see that in general, there is free cash flow, which we want to see. So that's not a point of concern. It's more of a box I like to check off. Let's load this in down here. And we got a couple things here. So in the black, you'll see we got revenue growth and then operating expense growth in maroon. Basically, we want to see that the revenue is growing at a faster rate than operating expenses. And you'll see the difference in this purple down here. So we have revenue growth minus operating expense growth. And we want this number to be positive, because that means that the revenue is growing at a faster percentage than the operating expense. And you'll see that although it goes up and down, there does seem to be, on average, a larger amount of positives. So that says that the revenue is outgrowing the expenses. That's what we want to see. If it was negative, that would say that the expenses are catching up to the revenue, which are going to put a squeeze on margins. So although it is hovering around 0 for the most part, I am pretty happy with how that chart comes out. And then for this last one, we do have the operating income, which is more or less the same thing, couple more metrics included, but this one shows an even better chart. You got some really high highs and some decently low lows, but in general, we're trading positive here. So we like to see that. That's another good sign. And then we have price of sales here. We want to see that this stays relatively the same, that the price isn't getting too inflated based off the sales. You can see of recently, ever since 2020, and this will align with the stock chart, that this has been coming down. And that's because although sales have been growing, staying maybe relatively the same, some growth with it, the price of the stock has been coming down incredibly, which will bring this ratio down. So if you were feeling bullish on the company at a 9 ratio, you should feel bullish at a 3 ratio, or it seems like we're even touching 2 here. So it's come down incredibly, which allows for that opportunity for misvaluing coming, or just having that chance to look at valuation of the company. So before, when you're at a high ratio, you're expecting a lot of growth. When you come down from that ratio, you have that room to say, okay, are we undervalued now? Have we pulled back too much? And saying that you're at a third of the previous price to sales, it brings into perspective that maybe we can look at valuation and consider that here. So happy with that. Below this for EPS diluted, so earnings per share, and this happens after new shares have been issued. So a lot of companies just report their EPS and they don't actually take into dilution. And if they're issuing a lot of shares, that's going to hurt the shareholder. We can see that, I don't know whether it's their earnings that's really good or that they haven't been issuing a lot of shares, but nonetheless, the earnings per share has been steadily increasing. So shareholders have been receiving more value as they stay invested in this company, rather than companies that might be issuing a lot of shares and bringing this actual EPS down, although their frontline, what they're showing EPS might be good. So another great sign for the stock, another box I like to check off. Then we're going to look at some of the rolling averages for revenue growth. So we're using K equals 4 in this case, which just means we're taking in the average of the 4 revenue growths basically. And I thought that was good because if we run, let's say an average of 3, you'll see here kind of an average that more or less kind of just tracks what's going on pretty closely. But if you take a 4, that's going to take into consideration the sale time of, December, November, those holidays that might just inflate the actual operations of the company. So if you're taking a 4, it just basically goes on an annual because we're talking about quarterly for these metrics. And we can see that you got 0 here, so that's no growth, 30% up here, 15% here. So we're trading about 10 to 9. And I did do the math on it, and it came out to about 9% average growth if we look at a average of 4. So this is pretty good to see. This is a fast-growing company. If you're growing at 9% on your revenue per quarter, that is just great to see. So very happy with this. This is a great metric, and sure, we're going to see some retraction on this. You can see over here, it's probably what the author of the article is kind of getting at, where they've had some recent struggles. But if you look at the high is still as high as it would normally be, and the low is within normal means, although it might be a little sharper than in the past, especially looking at like 2022 here. But nonetheless, this is still good. I'm pretty comfortable with it. So although there might be short quarterly issues, I think as an overall trend, the company is still doing great in that sense. Now, if we go down here, we're going to run this code, and then let's cut to the valuation. I do have the metrics already plugged in here, so we can look at the valuation based off of my assumptions, and then we'll alter those assumptions, kind of get more of a bear case and a break-even case on the stock. So if we look at their discounted cash flow value, that puts at a market cap of 34.82 billion. Look at the contributions of the growth stages. Stage 1 provides 3.21 billion. Stage 2 is sustained growth, provides 12.26 billion, and terminal gives 19.34 billion. Okay, so what does that mean, right? Okay, well, the high growth stage, stage 1, we're assuming a 41% growth rate for 3 years. Now, normally for the high growth stage, I put something like 5 years, but considering the contractions they've been having lately and the issues of keeping up their margins and revenue growth, I actually reduced that to 3 years. So I was already playing a little bit of a bear case here. So I said for the first stage, 41% growth at 3 years. And I used that 9% figure of revenue growth from a rolling average of 4 quarters, so an annual average of 9%. And then you compound that between 4 quarters. So when you do 1.09 to the 4th power, you get about 41%. That's where that number comes from. And then sustained growth rate. I would usually use a number like 10% for a sustained growth rate, but then again, for all the prior reasons we just stated, I said 7% would probably be the best for this. So I said 7% growth rate at 10 years of sustained growth. I do use about 10 years sustained growth as a baseline for this stage 2, and that's where that valuation comes from. And then for terminal, we said a 3% growth rate, which is industry standard when using a terminal valuation. And then that'll just go on for infinity, which is why we say a perpetual growth rate or terminal value. And that's where that $19 billion comes from. And we're discounting all this on a 9% rate. If we're doing a discounted rate of 10%, we're going to get a different valuation, which we'll see. Free cash flow margin, I looked up. They have a 5.92% free cash flow margin on all of their products. So we use that number, 128 million shares outstanding. And when you run all those numbers together and you discount it to present value, you're going to get a valuation of 34.82 billion market cap. And now when we take into consideration the shares of that, that brings in a share price of $272 compared to the current price of $169.62. Look at the valuation gap on that. That's 60.36%. Or if you want to talk in pure stock terms, it's undervalued by $102.38. Now that's a wide margin. When I do these discounted cash flows, I love to see there being undervalued because then you can make a case for buying the stock. But if it's undervalued by something like 20 or 15%, you're kind of on that edge. So a lot of your assumptions that you're making are important. When you have something like 60% valuation difference, you have room to move your assumptions. You have room to underperform your assumptions and still be undervalued. So let's look at that. Say they didn't do something like, okay, well, first let's change the discounted cash rate. So say we're discounting at 10%, right? If you're expecting the market to return 10%, okay, then you're at 34.67%. Now I think a discount cash flow rate of 9% is pretty fair, so we'll bring it back to that. Now let's say we had a 35% high growth rate, okay? Run the valuation on that. we're still undervalued by 41%. Okay, let's bring that number down again. 30% for the first 3 years. You're still undervalued by 26%. Okay, I kind of want to figure out where that 20% mark is. So let's go by 25%. Okay, 12.87. So between 25 and 30% high growth rate is like a comfortable position you have to be in. So if you think that for these next 3 years, the revenue won't grow at least, I don't know, 27 or 28 growth rate, then yeah, you could say, hey, I'm not interested in buying this stock. But if you're going to look at the metrics earlier, like we were talking about, I think 41 is pretty safe. If we wanted to just reduce it to 35%, which is fair. If you're saying it's slowing down a bit, okay, that's fair. You're still undervalued by 41%. So this gives a lot of margin, which is why I'm pretty bullish on Lululemon. And now I understand the concerns. Quite frankly, suing Costco isn't a good look for your company. It shows it's a little bit desperate, which makes sense. I think they have a product there, and they gave themselves a great brand image. I think that brand image, especially as people become more shopping conscious and they're more concerned about what's in their wallet. You know, the middle class is going to shy away from Lululemon. Lower class won't even consider it. Upper class, which does drive the majority of spending and an increase in the GDP in America currently, they'll stay at Lululemon. Definitely no problem. But they're going to start losing some of that middle class market share, which definitely makes up some of it. I haven't seen any figures on that, but I do think that's a legitimate concern. And then, yeah, as we did talk about, we can change some of these dates here for like where we want to look at the valuation. I think looking at about where COVID was, so let's go March 2020 to the current day, we can get a good view of what this is. So you can see this incredible growth. So even maybe further back, say 2018. Okay, you can see this incredible growth in the stock price, right? And they seem like they're doing really good. And then I think up to this point where people are very conscious about their money in the current economy due to recessionary signs, to be quite frank, slow down of the economy signs, you know, household income signs, and savings signs, all those metrics that we can see that aren't bullish for the economy, definitely. Ever since that's happened, their valuation has dropped considerably. And I think it's from the fact that people are going to start shying away from Lululemon, but at the same time, they're going to shop at competitors that have mock goods or dupes that can give you the same, almost, let's say, feeling of shopping at Lululemon, but for a fraction of the cost, maybe 40-30% of the valuation because they're made with cheaper materials or they're made in different countries. I'm not sure. But Costco seemingly is taking up market share. But with that being said, do I think this wouldn't be a buy solely because of that? I don't think so. I think with all the metrics we kind of looked at, there is a fair bull case, or at least slightly above neutral case for Lululemon. I think if you're buying it, in my opinion, based on what I saw, not advice, I think it's a buy with some reason behind it. I don't think it's completely invalid. I think if you're going to throw a bear case at Lululemon, you have to have some real strong evidence that not only will there not be a catalyst to help them, but there's going to be a catalyst to drive them down even further. I think they've already been struggling. And as long as they even keep up with what they're currently doing, they'll be just fine and that they will fit into this valuation. So, I don't know. Currently, they're at a price of $169. If you see that drop even further down with the metrics that we're looking at, it's even more of a case. If I saw this drop to something like, I don't know, 140 and I'll send an alert out there, then I'm going to start putting my eye towards Lululemon. So, a lot to think about today. This valuation is very unique and fun to go through. I think there's a great case here. Let me know if you guys have any of your own thoughts in the comments. I'd love to talk about it. Or if you have any recommendations for next week, over or under video. I love to make these ones. It is great practice for me and gives me potential stocks to look at for buying in the Roth IRA. So if you have any questions, let me know. Feel free to like, subscribe, share the video with your friends, and tune in for the next one.